Subscribers, welcome back. Today I'm bringing you a little bit of a short video. Actually, this is for my Year 13 economists, and a little bit of a feedback video here with regard to the questions that you had for homework, the macroeconomic questions. So just want to bring you your feedback today by way of video, and hopefully you'll see this and be all prepped for tomorrow's lesson. So it was just questions A, B and C, as you'll recall. Question A, a fairly straightforward question, just asking you to comment on the key macroeconomic variables. I think you all managed that perfectly well. Nice to see that phrase, derived demand, when you were talking about negative economic growth and that subsequent impact on employment / unemployment. So that was nice to see. I would also say to those of you who made comment on inflation, please do be more specific in your answers, and please address that to whether or not we're talking about demand pull inflation or cost push inflation. Moving on to part B. So this is the question: despite the Bank of England cutting interest rates earlier and more aggressively than the European Central Bank, the UK economy had not emerged from recession by the third quarter of 2009. Analyse the reasons why this was the case. So some interesting answers there, but a few of you didn't really get to the nub of this question. And so let me just throw out maybe 6 different things that you could have maybe commented on. Number 1, the paradox of thrift. Some of you talked about the fact that consumers and households would naturally have been rationally more thrifty and saved more, but of course there's that paradox there that when households save more, that subsequently reduces economic growth in the economy and thereby exacerbates the unemployment problem. So that's something to consider. Secondly, the liquidity trap. So it got to a point that no matter how far the central bank reduced the rate of interest, the demand for money became perfectly elastic. And you'll be familiar with that diagram, I'm sure, from some analysis that we did a few weeks ago. And as a consequence of that, it means that there are kind of diminishing returns with the effectiveness of reducing the base rate. Reducing it further and further and further basically has no impact on the demand for money, and therefore no impact on the level of economic activity in the economy. So liquidity trap, really important one. Thirdly, inelastic investment demand. Again, that's some analysis that we did a few weeks ago, just prior to the half term, all to do with the notion of the transmission mechanism. And we noted that when we have a liquidity trap and the inelastic investment demand, that means, you can picture that in your mind's eye, I'm sure, that inelastic investment demand curve, the interest rate dropping, but that does not stimulate lots of additional investment. Therefore, investment being a component of AD does not rise, and therefore the real output does not increase. Fourthly, some of you talked about the fact that households became really prioritised and obsessed with almost paying off their debts. And so buying new goods and services was no longer a priority. The priority, number 1, was to pay down debt, be that mortgage debt, credit card debt, HP, hire purchase debt, whatever it was. Number 5, confidence. Confidence took an absolute bashing during the Great Recession, and as a consequence, even though some households might have had some surplus cash, they did not spend it. And thereby there were no injections into the economy, therefore the economy was not growing. And finally, number 6, I think it mentions in the pre-release the stimulus material the fact that some firms chose to run down stocks rather than to produce more. And so as a consequence, even though they were able to sell more, put my teeth back in my mouth, even though they were able to sell more goods and services, they weren't actually manufacturing them because they were already stored in a warehouse somewhere. So that was part B. And then lastly, part C. Tricky little question, part C. I deliberately asked you to complete this one because it was about the fixed exchange rate system that we looked at just before half term. And while some of you have really nailed this, others have not. So a couple of key pointers here would be, a couple of key take-home points would be, if you're in a fixed exchange rate regime, unlike a floating exchange rate regime, then if you want to become more competitive, well, if you're under a floating system, you can just initiate a depreciation of your currency, export prices become cheaper, and then you kind of export your way into growth. You can't do that, as you should know by now, in a fixed exchange rate system unless you devalue. But ordinarily, you cannot just simply depreciate the currency. So your hands are tied there. And I think, secondly, and the most important aspect of this particular answer would be the fact that monetary policy, primarily the manipulation of the base rate upwards or downwards, that becomes redundant as a tool of macroeconomic policy because it has to be simply used to control the rate of exchange. If the exchange rate becomes too low, you need to push up the interest rate. If the exchange rate becomes too high, you need to push down the exchange rate. And you do that by way of either increasing or reducing the base rate. So you're then really just targeting the exchange rate value rather than economic activity in the economy. And the other thing to consider, which some of you did, which was excellent to see in your answers, the additional side effects of this. So if you increase the rate at a time when when I'm talking about the rate, I mean the interest rate. If you increase the base rate at a time when the economy is really struggling, then that's going to further exacerbate the growth problems in the economy because high interest rates, as you know, will suppress the components of aggregate demand. And of course, vice versa is the same. So that's it, guys. I've tried to make this as quick as possible, 6 minutes, 50 seconds.